We've had a big run since the beginning of the year, and we're just digesting those gains. It's think of it after a big Thanksgiving meal. What do? Is you lay on the couch and digest those those gains.
Yell at the kids.
Exactly. Yeah. So we're in a consolidation period, and I think after digesting these gains, we're going to move to new highs and possibly even hit an acceleration phase of this secular bull market.
Yeah, I've heard Melissa Lee and Bob Pisani talking about Tina lately. Not Tina Turner. Tina, there is no alternative. Interest rates keep coming down. Yeah. 2.36%. Does that make stocks simply look more attractive?
Yeah, I think there's a lot of reasons. There's fundamentals, there's technicals, interest rates, sentiment as well, as you mentioned, being the most hated bull market. But as far as interest rates, I think that's the biggest thing that changed everything. With the Fed almost put us into a, if you want to call it a Fed-induced recession in the fourth quarter. But when they came out in early this year and changed to patient and said we're going to be patient with interest rate, that's the biggest two things that control the market are earnings and interest rates. Earnings are strong, and to your point about interest rates, they're still very low, and it's a favorable environment for equities.
Earlier, we had a piece on how the FANG stocks are starting to come back. Yeah. Is that important?
Yeah, I think
not just for those stocks, but for the overall market.
Yeah, I think that's good. What I like is that we got to new highs just at the end of April without participation from the FANGs. So that means it's not just a few stocks moving this market. So we're seeing, but the fact that the big institutions, when they do need to put money to work, because a lot of them are underinvested, they tend to gravitate towards those FANG stocks because of liquidity, and it's easy to put money to work in those names.
And the fundamentals, I guess you like 75, 76% of companies have beaten earnings guidance. And I don't care about earnings. We care more about guidance, but guidance has been pretty good.
Yeah. Fundamentals, as you said.
Look at Cisco last night.
Yeah, I think it was, 76% so far of S&P 500 companies that reported have beat earnings. 60% have beat revenues. GDP growth, 1.5% to 2.5% for the past 8 to 10 years. We've seen a little bit over 3%. If we can consistently see that moves the needle, even though it's only 0.5% or percent. It's like a big tanker ship on the economy. It moves the needle pretty much.
So I said 3 reasons. There's really 4 to be longer term bullish. You've got the technicals, which are pretty good.
Yeah.
Fundamentals are pretty good. Sentiment, nah, but that's good. We don't want it too good. And interest rates are down, but let's fight now.
Okay.
All that stuff, tariffs, Brexit, does all that stuff literally just get swept out to sea because of this massive global trade fight we're about ready to enter or are already in the middle of?
I like to focus on what the big institutions are doing to touch on the technical part. So think of all the news that's hit us over the past 5-10 years, whether it's Ebola and Yuan devaluation, all these interesting elections all over the world. But at the end of the day, the big institutions control the markets. So I want to track what they're doing. So it's not me buying 1,000 shares or even you with your big bankroll buying 10,000 shares that moves the market. It's the big pension funds, mutual funds, hedge funds that are buying millions and millions of shares. And my point is, so far this year, they haven't been doing much selling. So I want to follow what the big institutions are doing and not saying pay less attention to the news, but at the end of the day, if they're the ones who control the market and they're not really selling, why not stick with the trend?